bring back the
You ready? Yeah, you got me running, you got me running, got me running. Shake it, shake it, shake it, baby. Raise your hands up, raise them out.
All right. Hi, everyone, and welcome. It's a new week, and I hope everyone had a great weekend as well. Welcome to all the members from the LCMS Traders Club that are watching this live as well. And I hope that if you are watching this on YouTube and if you are looking to gain access into the LCMS Traders Club, to make sure you do join us. We are taking new members on via the Jindao Tai website. And it is Monday, and there was obviously quite a bit going on Friday evening, which will be covered with Kim Hong shortly. But just before we get into what is happening in the markets and the trade ideas for today for the Aussie and Kiwi, I'll just go and present the risk disclaimer as well. So we will be sharing trade ideas today as well. So I'll read this out. Any information shared in this video is not intended to be a trade recommendation. It is solely the opinion and views of the speakers. So please remember to do your own analysis prior to entering any trades. So just to start off, we do have Kim Hong here, currency strategist at LCMS Traders, to discuss what happened with the NFP result on Friday night, and also a summary of the RBA rate decision as well that occurred earlier in the week, last week on Tuesday. So I will hand it over to you now, Kimmy.
All right. Happy Monday, everyone. Happy post NFP Monday. Okay. So before I actually head over to the break down what happened during the NFP, let me just go through what happened during the RBA meeting. All right. It was actually I would say a surprise after a surprise, not a surprise. Okay. So during the meeting, last week, the RBA, they actually ended their QE. Okay. So previously they were still doing like some 4 billion Australian dollars bond purchase per week. Okay. And then they were actually saying there were actually 3 options to consider. One of them being to end QE, another one being to taper QE further and carry out another round of evaluation probably like a couple of months down the road, and then another one would be just to hold the QE unchanged, So I was actually mentioning that 2 of the possible scenarios that may take place is either they were to taper and reevaluate the whole situation again during the next meeting, or end QE at one go. So they decided to choose to end QE at one go. Well, as you guys probably know why, right? Inflation rising and things like that. And of course, ending QE at the moment, will give the central bank more flexibility in the near future. If they want to increase interest rates, right? Because normally central banks would prefer, to end QE before considering any possible rate hikes. Of course, there are some exceptions, like the Bank of England, right? But many of the major central banks, like the RBNZ, New Zealand Central Bank, or the US Federal Reserve, and the Australian Central Bank itself, would prefer to actually carry out, to consider rate hikes only after QE has ended. So good thing, right? RBA ended QE, so we're supposed to see Australian dollar rise, okay? But that's not the case, all right? When the statement was released, the Australian dollar actually weakened. Why is that the case, all right? Let me just show you guys the main reason why they decide to carry out this, okay? So over here, the decision to end purchases under the bond purchase program follows a review of actions of other central banks. Okay, like I've always mentioned, the U.S. central bank is the major central banks. Okay, which is often observed. Okay, by the other central banks like the RBA or the RBNZ, BOE, ECB, SMB, or even the BOJ. Okay, so the functioning of Australia's bond market and the progress towards the goals of full employment and inflation consistent with target, which is a good thing. Okay, many other central banks have ended or will soon end their bond purchase programs. More importantly, faster than expected progress has been made towards the RBA's goals, and progress is likely. Okay, so right now, the RBA is usually quite conservative, when it comes to when it comes to moving towards policy tightening, okay, when it comes to ending QE or even considering a rate hike, okay. But right now, what they are trying to say is that, in terms of employment, in terms of inflation goals, okay, progress have been made. Okay, progress have been made, and more progress coming in is likely, okay, to be the case. All right. So it's clear, okay, that that RBA is pretty convinced that we should end QE right now. Okay. But let me look at this. Okay, so why did the Australian dollar ended up weakening in the end? Okay, it was simply because of this. Okay, like I've mentioned, the RBA has always been conservative. Okay, Governor Low himself is super conservative. All right, always trying to try not to taper QE as much as possible. Okay, during the previous few months of the meeting, but at this time around, they have no choice but to end QE. Okay. What's next? Okay, over here, it's stated that ceasing purchases under the bond purchase program does not imply a near-term increase in interest rates. Oh my goodness. Okay, so the market in general was actually hoping that was expecting that RBA will actually end its QE this time around, okay, or at least at the minimum taper, okay, maybe by 1 or 2 billion per week, okay. Because, okay, the general public, okay, is actually hoping that doing so will actually bring forward the central bank's timeline for interest rate hike. But that's not the case, okay? And Governor Low, being the smart central banker out there, okay, he knows that what the market is expecting, and he actually gave an answer to it. Okay, ceasing bond purchase under ceasing purchases under the bond purchase program does not imply a near-term increase in interest rates. Okay, because Governor Low has mentioned several times already, they will want the central. The central bank will not want to increase interest rates until at least wage inflation is high and things like that, okay, which is not really expected until 2023, which is why 2022 we are not actually expecting any interest rate hike from the RBA. Okay, so this part over here, this line over here actually just throws everything off. Okay, and then let me find another one which is over here. Okay, I should have just quoted this whole thing over here. As the board has stated previously, it will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. Okay, yes, inflation is rising, but the central bank, as much as the central bank acknowledges the progress being made in employment, in inflation, it is still not convinced that it will remain, okay, inflation will remain within the 2 to 3% target sustainably, okay, which is what central banks wants to do. ECB, Federal Reserve, they want this whole inflation to be sustainable in the near term, okay, and hopefully in the long run, okay. While inflation has picked up, okay, it is too early to conclude that it is sustainably within the target band, okay. There are uncertainties about how persistent the pickup in inflation will be as supply side problems are resolved. Wages growth also remains modest, and it is likely to be some time yet before aggregate wages growth is at a rate consistent with inflation being sustainably at target. See, this is the I would say this is the main paragraph that actually throws off the Australian dollar. Okay, so there's a technical term to describe this action carried out by RBA. Okay, so they end the QE. Okay, they end the QE, but then because the dovish tone in terms of interest rates actually turns everything down. Okay, so this is actually considered the dovish dovish conclusion of bond purchases. Okay, dovish conclusion of QE. Okay, just like how some people would deem dovish hike or hawkish cut in interest rates and things like that. Okay, so the similar term can be used in terms of quantitative easing in this case. Okay, so in summary, okay, wait, before that, one more point. Okay, so now that the QE has been ended, all right, what's next? Okay, we have seen from other central banks that once they end the QE, they may proceed to reinvestment phase and things like that. Okay, so how about the RBA? Okay, reinvestment. Okay, over here it says the board, okay, the central bank will consider the issue of the reinvestment of the proceeds of future bond maturities at its meeting in May. Okay, that means I don't think the next meeting is in May. The next meeting is probably in March or April. Okay, but the meeting in May will be crucial. Okay, because it will, they will provide us with an update of whether or not they will, switch over to this whole reinvestment phase of bond purchases, or will they actually, if more progress were to be made, okay, one possible scenario that the RBA may shift to is to not even consider anything about reinvestment of proceeds. Okay, they will just start to slowly unload its bonds holding. Okay, that is something that we hope will happen. All right, because at least the market will be hoping that to happen. Because with that, once again, they will try their luck on hoping that the central bank will shift forward their whole rate hike timeline. Okay, that is what we get to find out in May. All right, but right now it's just like February, so we have few more months to go before this major announcement by the central bank. Okay, so the quarterly monetary policy statement was also released. Okay, and as usual, okay, actually this is actually much shorter than I expected. All right, the statement, but the main gist of this statement over here is the economic projections. Okay, let me see, where is it? Just do a quick search. Okay, so the unemployment rate declined to 4.2%. Okay, not this part over here. Where is the just okay, maybe I'll just give you guys the figures. Okay, I have the figures with me, but I think it's going to take a while to actually search in this statement. Nonetheless, I'll provide you guys with the link to the monetary policy statement. Okay, the more comprehensive of what went down during the meeting and things like that. Okay, and then you guys can read through if you guys are interested. But basically, the RBA is actually forecasting unemployment rate to be at 3.75 this year, okay, as opposed to the previous forecast, I think it was back in December, okay, or November, of 4.2%, okay. Hence, it's actually I would say a positive revision to unemployment rate in Australia, okay. And core inflation, okay, is expected to be 3%, which is if you compare the RBA's forecast to the other central banks' forecasts like the BOE or the Federal Reserve, this is pretty much still considered low, okay? Although 3% is actually within the central bank's target already, okay? But we will have to see how inflation in Australia will turn out in the near future before anything can be confirmed, okay? And moreover, the RBA will be revising these figures on a quarterly basis, right? So the next time will probably be like, I don't know, maybe in May, okay? During the May's meeting, they may actually release another set of quarterly projections, all right? And wage price index, which is basically wage inflation, all right, if you will, is expected to rise by 2.75% this year, which is, I would say, okay, not that bad. Although it may seem a little low, I would say, because wage price inflation is something that the RBA is actually paying a lot of attention to. Okay, if wage price remains stagnant, okay, then it is unlikely that we're going to see a rate hike in 2022. Okay, maybe even early 2023. Okay, rate hikes may even be pushed back further to late 2023 or even early 2024. Okay, if wage inflation were to just remain stagnated and things like that. Okay, so that is the economic projections from the RBA. Okay, let me see if there's other stuff to consider. Let me get the economic calendar. Okay, not at the moment. So that's all I have to share for the RBA. Okay, do you guys have any questions on RBA? Happy birthday, Scott. Oh, great. Okay, no questions on RBA. Then you know what? Let's move to something more exciting. NFP. Okay. So, non-farm payroll. What should I say about the non-farm payroll last Friday? Okay, I'm trying to figure out a word stronger than strong surprise. I don't know. Can I use the word stupendous? Maybe. Okay. Why do I say so? All right. Look at this. Non-farm payroll employment change. Okay, non-farm payroll employment change. Previously, previous data was revised from 199,000 to 510,000. Okay. More on revision later. All right. And then, because of Omicron and things like that, the market was actually expecting a slowdown in the in the jobs market. Okay, so only 110,000 jobs were expected to be added into the economy. But look at the actual result: 467,000 jobs. This is easily like 4 times more than expectation. Okay. I'm not sure how many of you actually use the ADP non-farm data that's normally being released like a couple of days before the actual non-farm data is being released, okay? But if I never remember wrongly, the figure was actually negative, right? Let me just maybe just click on Wednesday. Okay, maybe just look at Wednesday to Friday, all right? Look, previous data was 776,000, okay? The actual data, okay, released under the ADP non-farm employment change was negative 301,000, meaning 301,000 jobs were expected to be lost. Okay, but what do we get? We get, we didn't get a loss. Okay, instead we get a gain in jobs by 467,000. Okay, it's very, 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 very strong. Okay, what is the main driver behind this? Okay. Leisure and hospitality. Okay, let me just show you guys the report. Okay, I'm just a bit stuck right now. Like, I'm still like stunned by this whole this whole set of data that's being released last Friday. Okay, so if you guys would look at this, okay, so this what you're looking at right now, summary table B, okay, is basically a breakdown of the individual sectors. Okay, and then we can see we're going to focus on the most right-hand side column, which is the January figure, okay? And then we can see that leisure and hospitality over here contributes 151,000 jobs, okay, which is actually the highest number, okay, of jobs being contributed in terms of sectors. If you were to look around here, okay, 444 is actually the total private payrolls, which is basically everything over here, okay, and then 440 over here is private service providing sector. So we just want to look at retail, wholesale, utilities, information, financial activities, and things like that, right? And you see that 151 easily beats the others, okay, despite the whole Omicron variance issue that has caused a rise in COVID cases in America for the past 2 months. I would say December and January. January figure is still easily 467,000. Okay. If you guys think that's the end of it, that's not all. Okay, that's not all. I'm going to show you guys this thing. Okay, so starting from this release, all right, the U.S. Bureau of Labor Statistics, they had carried out a revision to establishment survey data. Okay, so basically what they are trying to do right now is, from time to time, well, I won't say from time to time, but every month when this jobs report is being released, okay, the previous 2 months data, okay, so right now, this set of data being released in February is actually for January, okay, the figures for January. And for the previous 2 months before January, which is last December and last November, data will be subjected to revisions. Okay, so that revision, maybe it's definitely due to ambiguity of what do you call it? Ambiguity and what do you call it? Discrepancies caused during data collections and data tabulations and things like that. Okay, and then there's another kind of revision which is called the seasonal revision. So what the Bureau of Labor Statistics decided to do is to provide us with a more provide us with a more updated set of figures, okay, with seasonal adjustments included. Okay, let me see, where is it? As part of the benchmark process, the seasonal adjustment models are also updated. Okay, so I believe from now on they'll provide us with this table A, okay, that that includes I'm not sure if they're going to omit January 2021 during the next meeting, during the next release, and add in January 2022 instead. Okay, but we'll see how it goes. But basically, there are two main sections over here. One is level, one is over the month change. Okay, so what we want to look at right now is the over the month change. Okay, and as previously published was the previous one, as revised is the latest one. Okay, so you guys have seen that I've talk about the previous what do you call it? Is it January? Oh no, the data for December has been revised from 199,000 to 510,000. Okay, which is actually a 311,000 upwards revision. Okay, so from now on we'll just pay attention to seasonal adjustments. Okay, which is what the BRS is providing us with. So over here, it may seem a bit hard to, okay, actually it's not. In November, okay, 249,000 jobs was the updated figure, okay. But then after considering seasonal change and adjustments, okay, 647,000 is the actual figure, okay, which is a 398,000 increase, okay, upwards revision. So we can see that for the past 2 months, November and December, okay, there's actually a total of some 709,000 upwards revision, okay, which is very, very strong. All right, of course, okay, if you look at for the whole year of 2021, there's some downwards revision, there's some upwards revision. Okay, so you guys may think that to be fair, okay, to be more accurate, we should look at the whole year as a whole. Okay, which is why, okay, I have already tabulated a table for you guys. Okay, let me just show you guys the charts. So some of you may actually remember this table, this Excel spreadsheet that I've been sharing. Okay, let me just full screen this. It's just a habit that where's the full screen? Just here. Right. Okay, so previously, you guys have been looking at this, okay, which is the the non-seasonal adjustment factored in kind of a version, okay. But then right now I have already updated the figures earlier today, and we get this, okay. Just right. So what you're looking at right now is the most updated, I would say, figure, okay. Well, taking into consideration seasonal adjustments, and we can see that, okay, the number of jobs, okay, that is actually at the moment, what do you call that? The employment status of the US jobs market right now, okay, as compared to the pre-pandemic level, is just a negative 3 million jobs away, okay, from pre-pandemic level. That means, the current situation is actually, the current status is actually 3 million jobs away from pre-pandemic level. So graphically speaking, okay, you can see that, the graph is actually heading higher and higher towards the zero mark, okay, which is the pre-pandemic level before the loss of jobs was actually incurred by the pandemic, by the COVID pandemic. Okay, so there was actually quite a, let me just look at the previous one. Okay, so if you guys were to look at the data, okay, without seasonal adjustments, okay, there will be a loss of negative 3.2 million jobs, okay, at the moment, okay, as compared to the pre-pandemic level. All right, but with the seasonal adjustments, okay, we are only looking at close to 3 million jobs lost. So that means, all in all, for the year of from the beginning until now, okay, we are still looking at a positive upwards revision in the number of jobs being added to the jobs market. Okay, but for 2021, all right, I've calculated already. So for 2021 over here, okay, after factoring the what do you call it, seasonal change issue, okay, there is still a upwards revision of 217,000 jobs, okay, which is actually a very positive, I would say, overall it's still positive outcome from the 2021 jobs market. Okay, so back to the jobs report. Okay, so yeah, as you guys have already seen, the leisure and hospitality is the main contribution to the jobs market in January. All right, and one more thing I would like to bring you guys to is the participation rate. Okay, which is the table. Okay, so as you guys can see over here, all right, participation rate has rose, okay, from December's 61.9 to 62.2. Okay, once again, what this means is that more people are actually entering the labor force. Okay, so previously, I mean, if you were to say that due to COVID, people decides to just stay at home for the time being, okay, just to be unemployed for the time being, just to for safety factor, or just to take care of their kids because their kids were actually undergoing home-based learning and things like that. Fine, they will leave the workforce temporarily. All right, but then as things get better, as COVID situation gets better, people may want to enter the jobs market or workforce once again. All right, but then recently there's this whole Omicron issue coming in. Okay, so it is fair, okay, to actually expect some more people to actually leave the workforce, right? I mean, cases are rising like nobody's business, okay, in all over the world, caused by Omicron, right? It's more contagious, although less deadly than Delta. But it is fair to actually expect more people to leave the workforce, or maybe for the participation rate to remain stagnated. But again, we actually see an increase in participation rate, okay, which actually tells us that I don't know, maybe I don't, maybe people are less concerned. Okay, in America, it's people are less concerned about this whole Omicron variant at the moment. Okay, which is why despite this whole issue, rise in cases, people are still going to look for jobs. People are still going back into the labor market, okay, the labor force, okay, which is definitely very good. All right, and then so jobs figure is good, participation rate increased, okay, and then we have what other figures do we have? Okay, we have the unemployment rate. Oh, unemployment rate actually inched up slightly, but to be honest, this is no big deal. Okay, why is that the case? If you look at the graph, okay, it has been unemployment rate has actually been declining, okay, and right now it's 3.9, 4.0, but the pre-pandemic level was actually 3.5. We are just half a percentage point away from the pre-pandemic level, and this whole 0.1 inching up of this unemployment rate is I would say not too big of an issue, okay. And then if we look at the average hourly earnings, okay, we see that previous month, okay, wage actually increased by 0.5%, and is still expected to, and it was expected to increase at the same rate, okay, in January, but instead we get 0.7%, okay. More or less, okay, more likely than not, we may actually be seeing some form of a wage inflation already in the US, okay? Unlike in Australia, okay, where Governor Lowe has been, highlighting that wage inflation hasn't been rising, and we would want wage inflation to rise higher, okay, before considering rate hike. In the US, there you go. We are still seeing rise in wages and things like that, okay, which is actually a good thing, okay. So all in all, overall, this set of jobs report, okay, for the month of January, is actually very positive, and it has definitely confirmed, okay, with the Federal Reserve that their hawkish actions carried out recently, okay, is justified. It's warranted for sure. Okay, we have wage inflation, jobs has been rising even during Omicron period. Okay, hence maximum employment can soon be achieved earlier already. Okay, unemployment rate stagnating, I would say stagnating, although there's a slight inching up. Okay, but we know unemployment rate is around that level at the moment. Okay, people are starting to return to the workforce due to as indicated by the increase in participation rate, okay? And of course, inflation, I think inflation data will be released this week, okay? But we have been seeing months of high inflation and record-breaking inflation and things like that. So with the dual mandate pretty much, I would say, secured by the Federal Reserve, the Federal Reserve will feel more confident from now on, okay, when they make statements about, when the individual members of the committee, okay, were to make statements on, I expect how many so-and-so rate hikes this year, I expect rate hike as soon as when, and things like that, okay. So overall, very positive statement from the Bureau of Labor Statistics, and hence we actually see a strong rise in US dollar across the board, okay? And any questions on this non-farm payroll report or maybe the RBA statement? Okay, if there's no questions, okay, I will hand over this to Scott for his analysis on dollar index. Back to you, Scott.
Thanks for that, Kimmy. And I'll just get into the chart now. And what I have noticed with the index is that we are tentatively creeping higher, and it's been just an interesting situation, to put it broadly, just with how the US dollar has been behaving with everything that's going on. We've got around a month or so to go until we have very likely an interest rate increase in the US, and we haven't really been seeing a lot of upside from the US dollar. But looking at the chart now, this is just the 1 hour time frame, we do have some resistance at 95.50. We're currently trading over that as well, and we did have the previous hourly candle close very close to 95.60 here on my chart, and it does look like that we have sort of bottomed at the low 95s. We really needed, if you were bearish on the US dollar, to see that NFP result, as explained by Gimme, to come in a little weaker, and it did not. It really exceeded, and we saw the break, and we're pulled back here, but we are pushing higher. So just from what we saw there, I would say it's just lagging from the data. So the US dollar, frankly, should be priced a little higher. We're not seeing that. We are still seeing a little bit of what I just said there, of a lag. We saw some euro strength as well last week. Now, can that hold up? That's a good question. We'll discuss that further tomorrow, though. We've got Aussie and Kiwi in focus today. But over 95.50, I am bearish. And I don't have a trade running, but even a 95.40 stop with potentially some continuation would be more what I would be favoring. And I just quickly want to touch upon the upcoming news that I am watching out for. So just with the calendar here, we've got not a lot today or tomorrow, or even really Wednesday, but the CPI month on month and core CPI month on month is out 9:30 in the evening, GMT +8. So that would coincide pretty nicely with the evening call as well, to prepare you for that. So, and very likely we've seen recently with these types of figures coming out, you see a bit of a lead up in the US dollar where it might be pricing in higher inflation. So there's some opportunities before the news release to avoid all that volatility that can hang around for some time after the news. So I am long biased on the US dollar as well. We're seeing some mixed things happening in equity markets currently. It's just sort of early days. It's sort of break even right now in the Australian market. So I would say there's not enough information to say we're looking good in that regard. And risk sentiment is still sort of flat, with really slightly risk off, just seeing how we're seeing the US dollar behave and the Aussie dollar and New Zealand dollar sort of a little weaker as well. But we will be discussing that today, and we've got Gim back for that as well, just to go into what is looking from a trade perspective on the Aussie and Kiwi. So back to you now, Gimme.
All right, thanks, Scott, once again. Okay, today is Monday, so we'll be looking at Aussie dollar and Kiwi dollar, the anti-podium currencies. Okay, so starting off with the Aussie dollar, all right. On a daily chart, okay, we can see that last Friday, all right, over here, there was actually a strong weakening in the Aussie dollar. Well, as you guys may have already know, right, due to the strengthening of the US dollar, okay, caused by the very positive jobs report by the BLS, okay. So, well, Aussie dollar actually bounced off my resistance of 0.716, and at the moment, okay, the move has pretty much stagnated for now. Okay, I guess liquidity and trading volume is not that high at the moment. All right, but okay, I'll still be looking for selling opportunities. Okay, if we're to head down to H4, we can see that right now there's some slight retracement. Okay, but in a case whereby Aussie dollar were to go lower, okay, to 0.705, I'll be looking for selling opportunities, okay? Selling at 0.705. Stop loss will be set at 0.709, and my potential take profit will be at 0.701, okay? Both stop loss and take profit will be at 40 pips level. Okay, pretty much 1:1. I would say this is kind of like a pretty short-term trade. Okay, with the CPI coming up this week, and of course the the potential profit over here is not as high as the usual trade ideas, okay, because it's very close to my support of 0.70. All right, now if you guys are conservative, then some of you may not want to take up this trade idea because it's getting closer and closer. It may actually come closer and closer to the support level. Then you can actually wait for the support of 0.70 to be broken, okay, before looking for more selling opportunities. But to be honest, okay, with the CPI data coming up, okay, I'm actually very excited to see how it will perform, all right? If once again, we were to see another record-breaking report, inflation report coming from the BLS, all right, I don't know. Aussie dollar may very well break the 0.70, okay, depending on how it goes. All right, that's one thing coming from the US side of things. Australian side of things, remember, it was pretty dovish from the RBA as well. Okay, that definitely, I think it was, I can't remember when was the RBA, but yeah, I suspect this long H4 candle over here was actually a strong, was like a strengthening of the Aussie dollar, and then after that, coming back down again, okay, because of the dovish comments made by the central bank. Okay, so with, I would say, a dovish RBA, okay, and a very positive economic data coming from the US side of things, we may actually be seeing Aussie dollar hit lower, okay? But at the moment, okay, we have to pay attention to the 7-0 key level, which is coincidentally my support level as well, okay? And I mean, well, everyone has different support and resistance zone, fine, but still 0.70 is, I would say, a strong psychological level, okay? Because, well, you know what, let's just look at the weekly chart and see when was the last time we actually traded lower, okay, below 0.70. 0.70, which is over here. Okay, the last time it was trading below was actually back in last July, okay, probably like some, I don't know, 9 months ago or something, all right? It was actually strengthening, and then that's it. Ever since then, for the next 9 months, it was actually just trading above it. And then right now, okay, for it to break below this key level, okay, we will probably need something convincing. Okay, we need some strong conviction out here. All right, dovish RBA, hawkish Fed, positive US economic data releases and things like that. Okay, well, we may actually be seeing 7-0 being broken. Okay, but seeing how it goes, okay, for the time being, if you guys want to look for selling opportunities, 0.705 is your best bet, okay? So that is for the Australian dollar. Now, heading over to New Zealand dollar. On a daily time frame, okay, well, I would say it should come close to the 0.67 key level over here, although it's quite a distance away from my my resistance, okay, 0.70, which is indicated by this blue solid line, all right? And it's, well, as similar to the Australian dollar, okay, you actually hit it lower because of the strong NFP report, right? And if we were to look at 4-hour time frame, okay, I would still definitely be looking for selling opportunities from the New Zealand dollar, okay? We didn't hear anything from the RBNZ in recent months, okay, probably because of end of the year and things like that. But I think they are going to be meeting probably this month or next. I believe it should be this month in February, okay? And well, they are expected to hike. But the thing is, they can no longer carry out the whole hawkish interest rate hike thing, because ever since last year, okay, late last year, when new COVID cases were discovered in New Zealand, the Reserve Bank of New Zealand has decided to adopt a more conservative, cautious approach to rate hikes. Hence, they are looking at 0.25% hike each time round from now on. Okay, so unlikely the Reserve Bank of New Zealand is going to win the Federal Reserve in terms of hawkishness, okay? But that is until the next meeting, okay? For now, there's not much going on in New Zealand, okay? I think the last piece of New Zealand data being released was the quarterly employment figure, okay? Which didn't perform that well as well, okay? I mean, it's pretty, I would say, it's not, there's no wow factor in it, okay, in that set of released economic data. So what we're going to do is to continue to look for selling opportunities, okay? And you can see there's a strong rejection this is, of course, the NFP, right? Oh, not NFP, sorry. Earlier on today, okay, NFP was this part over here, okay? 2 bearish candles, okay? So if New Zealand dollar were to trade lower, okay, because at the moment, there's another key level here, 0.60 over here, okay? So it seems like NFP managed to push it down to test, okay, the 0.66 key level, okay, but at the moment it's just, you know, bouncing up, bouncing off, trying to go lower, okay. Now we will need New Zealand dollar to break below 0.66, okay, before looking for selling opportunities, and 0.658 will be my selling entry, okay, and then my stop loss will be at 0.661, which is 30 pips, okay, and then my potential take profit will be very close to my support level of 0.654, okay, so my take profit level will be at 0.655, which is also a 30 pips take profit, which is, to be honest, I would say a bit aggressive, okay, at this point of time, because we have pretty not much of a, I would say, trading space, okay, for our potential profit. All right. Similar to Australian dollar, okay, if the US CPI data release were to be very good, fantastic, okay, then we may be seeing a further strengthening of the US dollar against the New Zealand dollar. Okay, then if it actually breaks below this support of 0.654, okay, good, then we can definitely look for better selling opportunities. Okay, if we were to look at the weekly chart, the last time New Zealand dollar was actually trading below this support level, wow, there's too many lines, okay, was also mid 2020, okay, like some 9 months ago, okay. So depending on how you guys, you know, your appetite is, okay, if you guys are more aggressive, then you guys can look for short-term, okay, trading opportunities in New Zealand dollar as well as the Australian dollar, okay. If you guys want to take it safe, okay, wait for the US CPI data to be released before looking for more further selling opportunities, okay, then you guys can wait for the support level of Aussie dollar and New Zealand dollar to be broken before looking for further selling opportunities, okay. I mean, come on, other than Aussie and Kiwi, there are definitely other pairs to trade as well, right? It just happens that today's Monday, and then we're going through Aussie and Kiwi, and then, oh well, you know, it seems like the trading space is pretty small, and you know, we have limited profits to be made, okay? So that is the trade idea for Kiwi dollar. Any questions on the trade ideas, or even on the what do you call it, the fundamentals that I went through earlier today? Okay, if there's no questions, all right, well, if you guys have any questions, as usual, just put it in the Ecofin chat platform, all right? With that, I will hand it back to Scott.
All right, thanks, Kimmy. Thanks for everyone for joining us as well. More updates to come in the Ecofin chat with the trade ideas too, guys. Thanks for watching, and hope to see everyone tomorrow for the Euro analysis. Have a great rest of your day, everyone. Bye for now.